Most people enter a 401k with a very simple and very sincere intention. They are not trying to get rich quickly. They are not chasing flashy returns or speculative bets. They just want a stable life in retirement. Each month, they set aside a portion of their income, sometimes small, sometimes barely noticeable, and they trust that discipline, combined with time, will be enough to protect their future. Choosing a few options that sound safe gives them a sense of reassurance, as if they have done everything a normal, responsible worker is supposed to do. That belief is reinforced by how the 401k itself is presented. It is tied to the workplace. It is encouraged by the employer. Sometimes it even comes with matching contributions. All of this leads many people to assume that a 401k is a system that has already been vetted, optimized, and fundamentally made safe for those without financial expertise. They believe that if something were seriously wrong, surely someone, somewhere, would be responsible for checking it. As a result, most participants do not closely monitor their 401k. They do not read the fee disclosures carefully. They do not compare investment options. They do not question the small amounts deducted year after year. Not because they are careless, but because they believe they are doing the right thing, investing for the long term. Staying calm, not overtrading. In their minds, letting time do the work is the most responsible strategy of all. That trust, however, becomes a dangerous blind spot. While the investor waits patiently for the future, small and barely visible fees continue to operate in the background. They do not announce themselves each year. They do not trigger warnings or invite scrutiny. Instead, they quietly take a portion of returns, year after year, precisely during the period when the investor believes they're being protected the most. Fees in a 401k do not arrive as a bill in the mail. They do not knock on your door. They never ask for your signature or renewed consent. They simply exist, silently deducted before you ever see what your real return actually was. When you log into your account, the number you see is already the after-fee number. The danger lies in the fact that these fees are small. 1%, 0.5%, sometimes only a few tenths of a percent per year. They are too small to hurt. Too small to cause alarm. No one loses sleep over 0.5%. Nothing dramatic happens, nothing feels wrong, and because of that, they are allowed to persist year after year without challenge. But investing is not a game of short moments. It is a game of time. And in a game that lasts decades, it is not the dramatic events but the small, repeated leaks that determine the outcome. Each year, fees do not just reduce principal, they also remove the future growth that principal would have generated. The following year, the loss compounds on itself. This process is quiet, gradual, and relentless. It is like a tiny crack at the bottom of a boat. You do not sink immediately. But if the crack is never sealed, the water rises inch by inch, until one day the damage seems sudden, without anyone remembering where it started. Fees in a 401k work the same way. They do not destroy your retirement plan in a year or two. They erode it slowly, steadily, over an entire working lifetime. And when retirement finally arrives and people look at the final balance in their account, very few realize that what cost them hundreds of thousands of dollars was not one big mistake, but thousands of small deductions, repeated quietly for decades. The first, and most heavily mined, resource in investing is not gold, not oil, but fees. Each year, those fees are not calculated on what you just contributed, but on everything you already have. Whether markets rise or fall, whether you make money or lose it, they're deducted all the same. A 1% fee sounds harmless. Many people tell themselves, it's only 1%. That is the most dangerous misconception of all. Because in long-term investing, 1% is never just 1%. It is 1% this year. Then 1% of what should have grown next year. Then 1% of the returns that were supposed to compound after that. Over and over again, for 20, 30, even 40 years. This effect is not loud. There are no alerts. No invoices that make you pause. But it erodes wealth exponentially, not linearly. The result is that with the same starting capital and the same market performance, a low-fee investor may retire with nearly $1 million, while a higher-fee investor ends up with only a few $100,000. Not because one was smarter. Not because one picked better stocks. Not because one was luckier. But because someone quietly took their share first, year after year. Another common misconception is the belief that higher fees are justified if performance is good. The reality is simpler and harsher. Fees are deducted before you ever receive performance. They are guaranteed. Returns are not. You are accepting a guaranteed loss in exchange for an uncertain gain. That is not investing. That is an asymmetric deal, and the disadvantage is always yours. Fees do not bankrupt you overnight. They simply ensure that you will work longer, take more risk, and arrive later, without fully understanding why. And precisely because they seem so small, most people never seriously question them. But fund management fees are still not the whole story. In many 401k plans, there is another layer of costs, quieter and harder to see, known as plan fees. These cover the operation of the entire 401k system, recordkeeping, custody, reporting, trading platforms, and bundled services provided by the plan administrator. The key point is this: you are not the one who chooses the provider. Your employer is. And employers are not required to choose the cheapest option for employees. They only need something adequate, compliant, and convenient. Often the decision is driven by administrative convenience, existing relationships, or simple inertia. This is what we've always used. Not by the long-term financial outcomes of workers. As a result, millions of employees are steadily paying for a system they cannot negotiate, cannot choose, and cannot clearly understand. These plan fees may be deducted directly from your account, but more often they are embedded inside investment options, quietly raising expense ratios, lowering returns, and blurring accountability. You never see a clear line that says, 401k, plan fee, $X per year. Instead, you see lower than expected returns, slower growth than the market, and a vague sense that maybe you are just not investing well enough. When in reality, money is being extracted at the structural level. The irony is that the 401k is marketed as a workplace benefit. But for many workers, it functions like a mandatory, fee-based service, where those with the least power pay the most. And because these fees are small, fragmented, rarely discussed, they are almost invisible. No one warns you when you sign your employment contract. No one explains their compounding impact during onboarding. And no one is accountable when, 30 years later, your retirement balance is far smaller than it could have been. You are taught how to contribute consistently, but rarely taught how to ask, how much am I paying? And who benefits from it? And that silence is the most expensive cost of all. More dangerous still are hidden advisory fees, fees disguised under comforting names like professional management, advised accounts, target date funds, or managed solutions. Many people never actively choose these services. They are defaulted into them, automatically placed into a portfolio deemed appropriate for their risk profile. There is no serious conversation. No question of, do you actually need this? Just an implicit assumption. Advice must be better. The problem is not that advice is inherently bad. The problem is that you are paying for a service you did not deliberately choose, and often do not need. Most advised 401k accounts are not sophisticated strategies. They usually involve automatic rebalancing, gradual shifts toward bonds with age, passive market tracking, technically simple actions, rebranded as professional to justify an annual fee. The danger is that advisory fees do not feel like fees. They do not arrive as bills. They are quietly deducted, continuously, even in years when markets are flat or falling. When you add everything together, fund management fees, plan operation fees, hidden advisory fees, total costs can easily exceed 2% per year. That does not sound alarming. 2% does not feel urgent. 2% rarely triggers action. But remember, it is 2% every year. On your entire balance. Deducted before you ever receive returns. In long-term investing, 2% is not 2% less performance. It fundamentally distorts the final outcome. After 30 to 40 years, the difference is not a few percentage points, it is hundreds of thousands. Even millions of dollars gone. Not because you invested poorly. Not because you lacked discipline. But because the system was designed to collect fees first and explain later, or not at all. The greatest irony is that the more you believe you are being taken care of, the less likely you are to question anything. And those very fees quietly determine whether you retire wealthy or merely scrape by. A 401k is not inherently bad. For many people, it is still the best way to begin planning for the future. But a fee-heavy, opaque 401k, left on autopilot in silence, can become the greatest enemy of the very retirement it was meant to serve. In the end, what leaves many people struggling in retirement is not that they failed to invest early enough, but that they invested without understanding how much they were paying. In finance, the most dangerous thing is not a big mistake, but small costs. Repeated endlessly.